Good morning, everybody, and welcome to this edition of our Weekly Think Tank for 22 Feb. My name is Carl Capoligua, and I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we check out the week that was and have a look to the week that will be. We'll do that after we talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees for fantastic reasons to make sure your next ASX share trade is with Think Markets. The agenda for today is to have a look at the key market moves for last week. We'll check out the current COVID situation, have a look at the key macroeconomic data that came out, some of the big broker moves from the week, check out where the value is in the Australian market, see what's going on in the technical analysis side of things, and then we'll have a look at the calendar for the week ahead. The week that was first, though, and a fall of just under 1% for the ASX 200. But when you delve into some of the sectors, the falls were far more severe, nearly 11% for the gold sector. And it's probably worth at this point having a look at the gold chart. So we can see here on gold a big uptrend that began in the middle of 2018, extending through 2019, 2020 through the COVID pandemic crisis. Obviously, gold tends to do well in a crisis, peaking in late July, early August 2020 at 2072. And it had a bit of a consolidation, but really over the last few months, it has started to show these lower peaks and lower troughs. And this is a weekly chart, so this is quite long term. And you can see I'm just drawing them in quite clear cut here, lower peaks, lower troughs. So each time we rally, there's less demand to take us through those old highs, a bit more supply. And each time we've come down, there's a bit more supply and a bit less demand. So not a great sign if this uptrend is to continue. We fell through that key support level, psychological level at 1800 during the week. But more importantly, we tested this last trough here at 1764. It actually broke below it, but closed above it by the close on Friday. That's, maybe providing a stay of execution, but should we close below that 1764, I think it does really complete a reversal, a topping pattern in gold, and it probably can come down into the 1650, 1600 level. So just a bit of an insight into why that gold sector fell about 11% during the week. There's probably some more downside there before we're done. Some of the other sectors that didn't do too well, energy. Now, energy prices were largely flat during the week. West Texas crude oil down a little, but Brent crude was up. Natural gas was a little bit higher. Maybe energy suffering there on the strength in the Australian dollar. Obviously, a lot of those energy contracts are priced in US dollars. So when the Australian dollar goes up, the value of those US dollar contracts comes down. That eats into the profit margins of some of those energy companies. Material stocks, largely led by those big minerals miners, they did pretty well last week in contrast because minerals prices shot up so much. We'll see that in a slide coming up. Information technology, a lot of overseas earners there. So I think the Australian dollar crimping some of the enthusiasm. We also saw one of the big tech companies, Altium, come out with worse than expected results. Didn't help. Property and utilities, I'll lump these in the same basket because they tend to underperform when long-term yields are on the rise. And we'll see in another slide, that was a sharp increase in Australian long-term yields, and that certainly hurt those two sectors. Staple sector, probably Coles was the culprit there. So they had a really sharp fall in their share price after their half-yearly results, and the rest of them a bit of a muchness. So I think we covered off on the key moves there. Having a look at the technical analysis side of things, and we're looking at the chart of the ASX 200. This is a daily chart here, and we can see the big drop on Friday after a pretty tepid sort of Wednesday, Thursday, but the week started well, didn't finish well. It's brought us back to our short-term trend zone here, which is this one in here, this light green area, which is what we call dynamic support. You can see time and time again, the price tends to bounce off this zone. Now, not all the time. Sometimes it goes a little bit below it. Sometimes the trend changes and we go into a downtrend. But generally, we see the price tends to bounce off this zone. So fingers crossed, this week we rectify that and we start to move back to the upside. If we don't, look, I still think we're pretty well supported in this area here, which is a very broad zone of consolidation, and we may see some support coming in there as well. And all of this is happening within the context of a broader long-term uptrend. So whilst in the short term, there's a little bit of a question mark over this bull market, I think in the long-term trend, I think we're still okay and we can keep the faith on this one, especially considering we should be well supported not too far down. Seasonally, March, April, May tend to be really good months for the market. So I think you want to, just be a little bit cautious, but also find stocks that you like, that if they're pulling back and they're coming into, again, we look at the charts and look at our support zones, we can, pick those up with a view that the market will start to come out of this little malaise, these doldrums, and start to look up towards the middle and back half of 2021. The underperformance of the Australian market is highlighted even further, I think, by the relative strength in, say, Asia. We've got the Nikkei up 1.5%, Shanghai and Hang Seng up just over 1% as well. And the latter two coming back from their Chinese New Year celebrations. Of course, those charts look very, very strong. In the US, a little bit mixed. S&P 500 pretty flat. Dow Jones a small gain. Nasdaq has had a great run, so a small pullback there. Nothing untoward. And Europe actually starting to look quite good now on the charts. FTSE up 1.5%. The CAC up nearly 2%. The DAX missed out, but not much in that really. Some of the key drivers of that strength in the Australian dollar, which is hurting some of our sectors locally, are these mineral prices. They are on fire at the moment. So nickel, we're looking at nearly a decade-long highs here. We've got nearly decade-long highs on copper, and these are big moves for 1 week, 7.5%. Now look at copper; it's up 55% over the last year. Nickel's up 56% over the last year. Tin was up 12% during the week, and there's a big supply shortage in tin at the moment. Zinc didn't do a whole lot. It's still performing pretty well though. Obviously, high-grade copper is the US version of the LME version up here, and iron ore. Huge week as well, up 6%. That's up 74% for the year. So strong tailwinds coming through for our miners, BHP, Rio Tinto, Fortescue, Oz Minerals, and the list goes on and on. But not doing so well, as we can see here, the precious metals, so hurting our gold stocks. As I mentioned earlier, look, energy complex was pretty flat, slightly higher on natural gas and Brent crude. The Australian dollar has had a big surge on the back of those rising mineral prices. But I think more importantly, on the back of this big rise in our 10-year bond yield. So we're quite used to the Reserve Bank of Australia talking about 0.25% interest rate rises and cuts, aren't we? Well, we actually had, for the best part of it, 0.25% interest rate hike during the week. Now, this is the market determining what rates should be, not the Reserve Bank. So this is the rate that the market is lending to other participants in the market. And that is an extraordinary rise for a single week, and it is dragging on stocks as well, because from a relative yield basis, bonds, typically we consider them to be risk-free. If they're yielding more, and stocks are typically considered to be more risky investments, if relatively they're yielding less, then we can see some weakness in the share market as a result. Obviously, higher market interest rates also mean higher borrowing costs, and it also drags on the valuation that the big fund managers put on companies, because they use these things called discounted cash flows. And you have it inside this, you have a discount rate which is set based upon this long-term rate. And when discount rates go up, the value of companies come down. So the valuations come down as interest rates go up. Okay, so that is also a problem. So I'm just trying to make some sense out of the week that was, and it was a pretty big week in many respects. Okay, this is not as serious by any stretch of the imagination. It's a little bit of fun. Where are we this crisis versus the last crisis? And this crisis is the light blue line. Last crisis is the orange line. And we're uncannily similar, aren't we? And it's amazing how close these moves are, both in terms of price and duration. Therefore, should we be concerned about what might happen here and maybe what might happen here? We'll wait and see. There's no reason for those things to match up, of course. But sometimes charts tend to, history tends to repeat, so we'll keep an eye on those. Have a look at the COVID situation, and it appears to be on the improve. Nicely so, 124,000 daily cases now in Europe. That's a 7-day rolling average, and it's well down from the nearly 300,000 cases we had back in November last year. United States, we're well below 100,000 now and heading in the right direction. The only one that's really not heading in the right direction right now is Brazil, and we've talked last week, actually we talked in depth about the correlation between this chart and the iron ore chart, and we noted that when cases in Brazil turned up, the iron ore price turned up as well, and that's because Brazil is a key supplier of global iron ore, and the COVID situation over there has adversely impacted that industry. with limited supply, prices tend to move higher. Have a look at some of the data out during the week. We'll kick off with Australia first, and this is generally the biggest data release we have for Australia on a monthly basis. And we did see some good growth in jobs, not as much as we would have liked, 29,000 versus 40,000 expected, and well below the previous month's 50,000, but some encouraging signs there on what types of jobs were created. So we did see a nice spike in full-time workers to the detriment of some of those part-time positions. So overall, the growth was 29,000, but there's actually more than 29,000 full-time positions created because we saw a loss in some of those shorter-term positions. So overall, that is a positive sign because if you're a business, you're not hiring full-time workers unless you're increasingly confident about your situation. So we'll take that as a big tick. The unemployment rate came down, but we know when JobKeeper rolls off, that's probably going to tick higher. The participation rate was largely flat. Having a look around the world, we talked about those rising bond yields, and that is occurring. We didn't talk about why they're occurring. They're occurring because the investors are expecting a lot of growth to come because of all the stimulus we're having, and they think that's going to flow through into inflation. And when we have higher inflation, we need higher long-term interest rates to compensate people for that inflation. So we are very sensitive to any measures of inflation at the moment, and this is one of them. So this is inflation at the wholesale level in the world's biggest economy. So it's important. And we don't want to see any spikes. But what did we see last week? A major spike. So that rattled markets a little bit. And we, as economists, we need to now determine, okay, is this an aberration? Is this something that's just a one-off because of COVID? Because, this is business to business inflation. We know we've got supply chain shortages. It's hard to move things around. It's hard to get things made. It's hard to get things from China on shipping containers at the moment. So we're seeing some prices at a business to business level heading up. The question will be whether those price increases are passed through to consumers, and that will tend to happen if businesses are really confident that consumers can withstand that and they're not going to lose market share by increasing their prices. And I'm not sure if we're there yet. So the big question mark is whether this will become consumer price inflation and whether it's going to stay at those elevated levels. Is it going to come back down and then we can, big sigh of relief. So look, we need to keep a close eye on that going forward. It was a massive release for last week. A very positive sign for the US economy was this big rise in consumer spending. So retail sales spiked to 5.3% increase month on month. That was, well above expectations and well ahead of the previous month's fall. So hopefully we're starting a nice little uptrend here. Don't forget, consumer spending is 2/3 of US GDP. Industrial production holding pretty well. It was down a little bit on the previous month, but still better than expectations. And the reason why we're expecting declines in some of these indexes is because of the COVID situation. So again, here, this one was better than expected, but it was still a decline because economists are factoring in some of the hardships that businesses are experiencing at the moment. This one was a clear beat, so that's always nice on the housing front. Housing industry in the US, a major employer. So very important sector of the economy. And looking at permits versus starts. So permits were well up on expectations and well up on the previous month, but starts at the moment being adversely impacted by COVID factors. So we won't take too much, I think, from the starts. The permits are probably the key ones there because they're going to turn into starts down the track. Weekly jobless claims, worse than expected and worse than the previous month, but somewhat encouraging. The continuing claims continued on a downward trend. Look, it's a pretty transient piece of data, this one, so we'll take that one in our stride. Bringing it closer to home, let's have a look at some of the companies that reported this week and some of the broker responses to those reports. Coles Group, the big supermarket chain, reported an 8% increase in revenues, 14.5% increase in net profit after tax. On the face of it, looked like a fantastic result, but in the presentation, the interview that the CEO generally does after these types of report releases, he came out and he said that I'll quote him here, the pig in the python is starting to diminish, and by that he means that these supermarkets have had a big feed in the back half of 2020 as the pandemic changed the way we spend our money on food, and we tend to eat at home instead of going out. we tended to stockpile, because we were worried about being stuck in lockdowns. So that's going to back out the second half. He doesn't think that Coles has any chance of showing the growth that they've seen recently, and brokers really focused on the negative commentary there. And I think we've even said, Macquarie cited management's downbeat assessment of the supermarket sector post-COVID as the reason for them dropping their share price. We saw Citigroup downgrade their rating from buy to neutral. We saw Credit Suisse downgrade their rating from outperform to neutral, and both of those brokers big price target drops as well, $21.20 down to $19, so $2.20. It's 10% drops in their target. Smaller drops at Macquarie and UBS, but I'll let you press pause and read the commentary. We've also got higher costs, pressure on margins, so there's a few reasons why we saw those downgrades, and also the market responded very poorly with a very sharp sell-off in the share price as well. Now, keep in mind when we look at these broker recommendations, they do take a few days to update at the data provider, so some of these might change, but generally we've got a positive reading towards it. I would expect that's going to moderate somewhat, as we will see a moderation also on these price target decreases in that mean estimate. Looking at some of the profitability ratios here, we can see a very, very solid enterprise value to revenue, but that tends to be the case for supermarkets because their revenues are so massive. And probably worth focusing more on the price to earnings ratio here. So what are we paying for the earnings of the business? Paying about 21 times earnings, which means it'll take you 21 years of earnings to pay back what you've paid for the company. That's a long time. Typically, we like to see that closer to 10. So this one's more on the expensive side of the ledger than the cheap side of the ledger. And it doesn't really have the growth to justify that high valuation. So typically this PEG, we like to see that closer to 1. It's just the PE divided by the growth rate. Obviously, the higher the growth rate, the lower the multiple is going to be. And less than 1 is considered to be a good level. And at 2.29, it's hardly justifying that high PE. The dividend yield is pretty good, however, and probably sustainable, given it's a really stable sort of business. So that is a bit of a bonus. The return on equity is actually very, very strong, isn't it? So that's so look, there's some good things in there. It's not all terrible, but I think the big impediment to me getting excited about this one is highlighted there in the P and the PEG. With the long-term trend broken now quite clearly, I think I'm a bit of an avoid on the chart as well. So previous to that, look, I would have said it's a hold, long-term uptrend. It's a bit flat, but worth holding. Now I'm not so sure. I think you want to be out of this one going forward, yeah. CSL is the next stock we're looking at. This one wasn't looking as good on the chart. It's a really flat long-term trend. It's still up technically, but it's very, very flat. The short-term trend is down. I mean, that's clear cut there. So the market was cautious to this one before this half-yearly result, which again, like Coles, on the face of it looked fantastic, but when you dug a little deeper, the big pop they had in revenues during the half were seasonal. So for CSL, it was to do with their influenza vaccinations in the Northern Hemisphere. Of course, it's wintertime over there, so we've got lots of vaccinations and a big profit boost from that segment of the business. But their bread and butter, probably a silly thing to say, so their bread and butter is blood, and their blood plasma collections are obviously adversely impacted by COVID, and therefore, their conversion to blood plasma products, which they then sell, is obviously adversely impacted as well. Now, the company is expecting that growth to come back, and of course we would expect this situation with COVID to normalise over time, but it's the time it's going to take for those earnings, that earnings growth to come through, which is concerning not only myself but the brokers as well. So we saw some downgrades here. Citigroup downgrading from buy to neutral, Credit Suisse downgrading from outperform to neutral, and Goldman Sachs from buy to neutral. We saw all but one of these brokers decrease their price targets as well in the back of those results. Macquarie was the only one which saw a very small price target increase, but otherwise all heading down. I'll let you press pause and read the commentary there. In terms of some of the estimates, brokers overall still fairly positive, but I would suggest again once these updates come through, not as much. In terms of the mean target, I think that's going to come down as well. But we are looking at still around 317. It's probably going to come down closer to 300 after this. So still some upside in that, but when you look at the valuation, it's hard for me to get enthusiastic about this one. Twice as expensive as Coles with half the growth at the moment. That's at the moment. It's going to improve, but really for this FY, for the next FY, and probably in FY23, we're going to see subdued growth, which just can't justify that high valuation. A pretty dismal dividend yield in the meantime as well to keep you busy there, unfortunately. So look, it's not a buy for me here. This is a question mark because it still needs to update, and the chart, I don't think it's a buy there. So it's a CSL still an avoid for me. Okay, having a look on the bright side of things, Westpac Banking Group, ANZ, NAB, they were out during the week, CBA the week before, with some really good results. And we'll just look at some of the broker comments here. So cash earnings ahead of expectations. We saw positive progress on write-downs and provisions. So the credit outlook, the credit quality outlook isn't as bad as we thought it was going to be. COVID hasn't had such a negative impact on the local economy. And the outlook continues to improve. Growth is coming back, all good stuff. Capital management. So all these big banks, a lot of these financial services companies came out and they raised a lot of capital in the depths of that COVID crisis, and then they didn't have to use it as much as they thought they would. So they've got lots of capital on their balance sheets now, which could come back in the form of higher dividends. And we are expecting these dividends to come back with a vengeance for some of these banks, special dividends, share buybacks and the like. So I'll let you read the rest of those, but brokers quite positive on those. We do have 5 out of 5 price target increases here, and some of them quite substantially so. With those increases heading in the right direction and no changes in the ratings, I think this is very solid. So we've got a tick here. This mean rating, which is 22.45, is only going to head up, so that's a positive as well. In terms of the valuations, look, we're at PE of 15, so we're better than the other two we've looked at, and we've got some growth coming back into the business, so I think that's a bit of a tick there. Dividend yields, they should normalise if we can look through FY21. I think that's also a big tick there. And other than that, I don't think there's anything stressing me out. That might look higher than the other two, but that's very, very typical for the banking sector. And, return on equity is still pretty good. So we've got a few ticks here, and the chart is a tick for me as well. We've got a really nice trend. I think if you can get it on a pullback, maybe into 23, I think it's probably better value than buying now, although I've got no problems with doing just that with buying right now. If you're a holder of this already, you would definitely stick with it. The long-term trend is probably going to switch to the upside, and I still think we're going to be heading in the right direction for the banking sector in general. Okay, having a look at where the value is in the broader Australian market, our PE is 19.34. To put it into perspective, 10 is typically considered cheap, 15 is fair value, and 20, unfortunately, is considered expensive, and, tells you where we are right now. But the rest of the world is more expensive than us, if that makes you feel any better. That doesn't mean every sector within the Australian market is expensive. Certainly we're seeing some cheapness, if that's a word, in the materials sector. Their PE is 12.5, despite the fact that we've seen some price increases there. Obviously, commodity prices are on the up, so the prices are on the up, but earnings are rising faster than those prices are increasing, and therefore the PE is actually coming down over the last month, and I think that gives scope for further price increases down the track. Financials at 16.3, not bad. What else is cheap here? Property trust. I avoid on property at the moment just because of those rising bond yields. I think there will be a time to buy them, but you could see that PE come down into the low teens before you get there. Technology, I'm a little bit concerned about the position here. At 73 and rising, it seems really expensive to me. So cautious on some of those high-flying tech stocks. I think there's better value elsewhere in the market. The rest of them are a bit of a much of a muchness. Okay, some of the technical factors here, and what we're comparing here is the stocks in the ASX 300 against their respective 5 period, 10 period, 21 period, and all the way out to 252 period exponential moving averages. So 5 periods, that's how many periods there are in a week. That would be a month there. There's about 21 trading days in a month when you take out weekends and public holidays, and that's about a year. So we can see that quite a bit of damage was done. Now, the blue line is a month ago, the yellow line is a week ago, and in each case, there is some damage done here. So we are seeing a lot of those share prices fall below those trend lines. Rather than being in uptrends, there's starting to be downtrends, and that's a real concern for me. That it's not just the short-term trends that are being impacted now. We're starting to see some of these longer-term trends being impacted, and that is a bit of a concern for me. We talked about the technical picture earlier on. I think we will be supported in the near term. We're hopefully going to find a buy point before we turn higher, but what I would like to see is a nice swing up in this curve before I have the confidence really to apply that next batch of capital. The good news is we're nowhere near the worst case scenario from the COVID depths, but we've got a bit of work to do before we get back up to those highs. The economic data calendar for the week ahead. Not a lot going on the Australian side of things. Nothing there, I think, that's going to be majorly market moving. So let's head to the rest of the world. We talked about inflation earlier on, so that we are watching anything to do with inflation very closely. It'll impact on those long-term bond yields. It'll impact on stock valuations. So we do have European CPI coming out on Tuesday. We're also watching for how this gentleman here, Jerome Powell, responds to those rising market rates. So it makes the Fed's job harder when those rates go up because the Fed's trying to keep rates low to stimulate the economy. How's he going to respond to these rising long-term rates? So he's got a couple of testimonies here, one on early Wednesday morning our time and then one on Thursday morning our time. Heading into the back half of the week, we do have some preliminary GDP out for the USA. Core durable goods orders, very important for me. We'll talk about them when we have to talk about them next week, but definitely watch out for a good print there. And then the Fed likes to look for these two, personal income and personal spending. And we close out the week maybe with Chicago PMI, but otherwise a pretty quiet week, I think, for markets. Won't be a quiet week for me. Earnings season in full swing. Plenty of reports to read, plenty of market updates to provide. Head to the market news section for all of those. You can follow me, all the Think Markets handles on Twitter if you like. Also on the website, get to the webinars page and you can register for any of these wonderful webinars. Ask the experts on March the 3rd, where you get to ask me about any stock in your portfolio. I'll give you a quick fundamental and technical on those. As far as I know, no other broker offers that service, so take advantage of it. Get onto the webinars page and register, and then we've got a couple of Think Learning webinars coming up as well. The disclaimer before I leave you says that everything we've discussed today is general in nature. We are a regulated Australian broker, and we do have some products that could see you lose more than your deposit. So make sure you read this carefully or give us a call if you have any other questions. It has certainly been a pleasure chatting with you this morning. All the best for your trading. Until we catch up again. Bye-bye for now.